Welcome to Scholar Trading's Fundamental Analysis 101. This is going to be an introductory course into the world of investing and long-term swings. It's brought to you in part with a colleague of mine. His name is Justin Weber. He is a Master's of Finance, and he's given me the opportunity to help you teach this particular training. Okay, so let's dive right in. Fundamental analysis is a method of determining a stock's real or fair market value. Okay, the three components that we're going to dive into today are going to be the economic analysis, industry analysis, and company analysis. The economic analysis relates to the analysis of the economy as a whole. So that would mean markets, specifically NASDAQ and Dow Jones in the United States. Index, that's more or less the same thing. That's the actual market itself, is how the NASDAQ and the Dow are performing. The market overall is all the individual stocks in the actual market itself. Okay, and overall sentiment, meaning what is going on in the country at that time, whether it be high inflation, high interest rates, like right now, where politics are going to be gearing, what kind of policies are coming out, and typically consumer prices, consumer price index as well, job claims, all that sort of stuff, right? These make very important key bits of information. Sorry, I couldn't get my thought process isn't quite there with the right words. But anyway, studying the economy in detail and analyzing whether economic conditions are favorable for the companies to be prosperous or depressed. As an investor, this can help predict whether the share price of a company is at its appropriate valuation on the basis of the forces affecting the economic environment of the country. So, like I was saying, interest rates, inflation, whether or not there was artificial money put into the system, as we've seen from middle or more or less beginning of 2020 until end of 2021. There's been a lot of stimulus going into the economy and encouraging people to spend more than what they had. Right now, we're going into a very depressed economy. So it's going to be, all the markets are going to start pulling back, right? Like you've actually already seen the entire year. They've been pulling back for about 12 months now. Okay, identifying a long-term entry based on the economy. So when the markets crashed during the beginning of COVID, many investors lost 40 to 60% of their portfolios within a few weeks. Those with the foresight in February of 2020 were able to see that the market would be greatly affected due to the fact that China is a major export of nearly all consumer goods. So we were hearing reports of COVID beginning of January to about beginning of February, and most people were shrugging it off. Those that knew how important a role China plays in the U.S. economy would be able to have the foresight to start pulling out and selling major stocks and major assets that they had. There were actually a few politicians that, for lack of a better term, kind of lied to a lot of people, saying there's nothing to worry about, and meanwhile they sold all their assets, right? So politics, you could typically follow those that are in charge of the country and see how they play their cards when it comes to something serious that could potentially affect the country as a whole. Okay, it took the market 1 month to drop 30%. And 3 months to recover from that drop. So that was an artificial crash, right? There was nothing besides the virus to be able to halt production. Like, everything was perfectly fine. Economy was perfectly fine. There was nothing showing that it would have stopped by any means. It's just, nothing could have been avoided here at this point, right? Nobody knew anything regarding the virus because all the information was being withheld. So at this point in time, the world basically needed to shut down for approximately 2 weeks until people could slowly figure out what was going on, right? So that's what affected the market right over here. Okay, this was the peak, and this is what started the drop, and we hit the bottom around the middle of March. All right, so when people said 2 weeks, that would have been a great indicator to show how the markets are actually going to go, right? Very good sign to see that, hey, they're going to be peaking around here. The 1 week that was really bad, and then when we hear the information that, we're going to shut down for 2 weeks, that would have been a great indicator to sell all your stuff and wait for the bottom, right? After the 2 weeks, because this is a weekly chart. Look, week one, week two. Once week two's over, started climbing, right? So just with that information, it was made available to everybody. It would have been a loss for the first week, but for the other two, you would have sold at profits and then snagged it up right here to easily start climbing for the next year and a half. Anyway, currently the US economy is doing poorly based on a variety of reasons, and this will affect the market overall. So those reasons, like I said, are inflation, interest rates, unemployment rates, policies, right? So everything's kind of adding up right now. In order to capitalize on these lows, the safest entry is to wait for the market to break a previous high. Timing an entry by assuming it is at a low point is the equivalent of catching a falling knife. There's small chance of success, but most likely you will cut yourself. So let's see all the factors that are part of the economic analysis. Okay, so I'll just rhyme them off quickly and then I'll dive into explaining them a little bit. GDP, inflation rate, taxation, interest rates, money supply, government debt, fiscal policy, more or less made by the government, monetary policy, made by the central bank, savings rates, trade deficit, exchange rate, unemployment rate. So let's start from the top. Okay, GDP stands for gross domestic product. That's the total monetary or market value of all finished goods and services produced within a country's borders in a specific time period. Inflation rate. Um, More or less, what an inflation rate is when a government prints more money and distributes more money than the country actually produces. So now, the higher that it grows, the lower the stocks will go. Certain stocks will recover faster than the index overall, right? Those would typically be your growth stocks. Taxation, taxes imposed by the government. Everything is taxed, so learn to love it, guys. All right. The more the taxes come out, so let's say right now, great example is, um, quote, climate change, unquote. It's everything dealing with this situation. It's driving policy and specific market valuations higher than they should be. For example, Tesla, right? Its actual value is around the $45 range, and it was trading around $400 about 5-6 months ago. Okay, it goes to show that because of the demand for electric vehicles now, it's not a demand because consumers really want them. It's a demand because right now people are worried that the government's going to impose some crazy taxes in order for the consumer to transition on their own. So that's what's going on with that. Okay, interest rates. Lowering rates makes borrowing money cheaper. This encourages consumer and business spending, and investment can boost asset prices. Higher interest rates tend to negatively affect earnings and stock prices. So currently, right now, I'll use Canada as an example since that's where I live. Our interest rates are 4.25%. So that's pretty high. It was at, I believe, 1.5% at the beginning of 2022. And it's gone up almost 3% within 1 year. So that's a lot, right? As those prices come up, that means it cools the housing market, and it basically makes people hold back a little bit because things become much more expensive because of those interest rates. Okay. Money supply is inflation occurs when money supply of a country grows more rapidly than the economic output of a country. Government debt. What the government debt owes creditors, including debt held by public and federal government trust funds. The fiscal policy made by the government. This is spending bills that are passed in Congress. So, like the most current one is the omnibus that was passed for $1.7 trillion dollars. And yeah, there's a lot of fluff in there that, again, doesn't really matter at this point in time. I don't want to get into politics. Maybe I'll make another channel for that later on. But anyway, so that's bills that are passed in Congress and then by the president. In the US, anyway. Other countries play around with it a little bit differently. Countries with a prime minister, they typically throw bills very quickly, and they don't have much opposition to deal with, especially if they hold a majority government. Anyway, if spending is higher than income, this will create a deficit, which will later be added to the debt. If spending is lower, then it will create a surplus, helping pay down the debt. Um, you can tell me whether or not you've ever seen a government hold a surplus. I can say that the Canadian government had a surplus, I believe, when we had Stephen Harper in power. Trudeau quickly got rid of that. So anyway, savings rate. This is a measure of the amount of money that a person deducts from their disposable income and sets aside. This simply means that rather than money being spent as quickly as it's earned, it's set aside for other purposes, such as investing, retirement, or paying down their personal debts. Trade deficit. A trade deficit occurs when a country's imports exceed its exports during a given period. If a country continually runs trade deficits, citizens of other countries acquire funds to buy up capital in the nation, such as land, resources, and businesses. So if you ever wonder why we have in Canada a slew of foreign investors, specifically in Vancouver and Toronto, this is one of the reasons. It becomes very cheap for outside investors to come in and buy property, especially when government policy allows them to do so. And this is how debt will essentially be uh, brought down, is with these foreign investors buying up government property. Right? In order to do this quickly without next future generations paying the price, that will be one way that the government can assist its people. But we'll see what happens. Exchange rate, the country's current value against another country. So again, forex is a great way of seeing the information there, right? Just go on any currency pair that you've seen in any other one of my videos, and it shows you exactly like what the value between the two currencies are. Okay, unemployment rate is the percentage within the labor force that is currently without a job. The higher the rate, the more government spending allocated to pay for welfare. And I have a typo, but that's okay. Moving on. Industry analysis. So after the economic analysis, industry analysis is important to determine which sector of the market will benefit most from the upcoming economic environment. This will guide you to find the right sector within the market to find an optimal stock. Many sites and apps have what's called an industrial heat map that divides the entire market into its specific sectors as shown below. So on the left, these are just screenshots. The one on the left is from an app, Webull, Webull. And again, it's free. I just use it to keep an eye on my watch lists, and the heat map clearly shows you how much the industry or the sectors as a whole are up or down. All right, so you can see energy is up 0.5% overall. Pharma and med is down 0.16% overall, and this means that this heat map is giving you the information of almost all of the stocks that are on there. I think it's, what is it, almost 5,000 now? Or is it 3,000? I can't be too sure because there's like 400 that are added in a month and another 400 that are dropped, right? And those are the ones that are just pumping nubs. But either way, these are great ways to see how the industry is doing as a whole, and which sectors that give you any interest you can pick from there, right? And on the right, we have it from the website Finviz, so finviz.com. And I'll put all the website links in the description after the video, or as you're watching it, I guess you can browse in there as well. But yeah, the links will be in there, and then you can see for yourself how it's going. And this is just a screenshot taken from a few days ago. Okay. So the industry life cycle, this is something very important because as stocks are introduced, right? So that's your introduction phase. A lot of them will have potential. Some will just be pump and dumps, right? But every stock goes through a life cycle. So I'll use two stocks. Two stocks? Yeah, sure. I'll pick two stocks right now as examples, and I'll just kind of vocally tell you about them and see where they're at in their life cycle stage right now. So Apple, right? We had its introduction back in the 90s or late 80s, and it wasn't doing so great, right? It started finally growing with the introduction of the iPhone. Before that, it was still a growth company, but it needed to find its niche. And once it got the smartphone technology up and running, that's when it started growing significantly, right? And Apple's been growing for a very long time, I believe for the last 15 years now, right? Shakeout is when a company kind of grows to a point where it can't sustain itself, or the hype was more than what the product was actually worth, right? And the shakeout is the stage where a lot of companies are just going to fall off the map and be forgotten about, and they're really not going to do anything. They're just going to try to coast along and survive. Or if there lots of positive growth and a lot of consumer interest, they will keep growing, right? So shakeout process gets rid of all the crap companies from the good ones in the specific sectors, and really eliminates competition based on the type of product that they're offering, right? So if you ever remember BlackBerry, right, their shakeout was when the iPhone was released. They weren't too worried, so they basically dropped off the radar and are nearly worthless now, right? Whereas Apple continuously grows. Same thing with Samsung, right? Samsung is now a direct competitor with Apple, especially in the smartphone. What do I want to say? In the smartphone market. Sorry, I kept trying to find the words there. But Apple, as we know, has multiple other technologies, right? It's not making TVs like Samsung or appliances, but it is doing computers and other software, right? So its direct competitor there would be Microsoft. So it has multiple competitors, but the unique thing about Apple itself, it's not going all in into one sector. It's dabbling in a few other ones. Right now, there's rumors about Apple making a smart car. We'll see how that goes. But either way, right now Apple's at the maturity stage, right? They're not coming out with any new products. There's no more hype. It's just the new phones that are being released, and people are just upgrading as it comes out. So they are currently now in the maturity phase. Very unlikely they're going to hit the decline unless some other new crazy technology comes out and they fall behind a new company, right? So they are currently in the maturity phase. Another one that to talk about right now would be Tesla. So Tesla had its introduction. There was a lot of hype back when it came out. Then it kind of dwindled into nothingness, right? And the more unique and fun Elon Musk became, the more volatile the stock turned out to be as well. Okay, so right now Tesla is sitting at its shakeout phase, right? It really had a strong growth phase, but now it's the shakeout phase only because there's a lot of mature automakers that are starting to compete with electric vehicles against Tesla. The only thing that Tesla has going for them is their how do I want to say it? Their consumer model. So instead of them having a lot and having cars on that lot and then people just browsing in between, they're just being ordered online. So really the cars are being produced as they're being ordered. It's a very smart concept that a lot of auto manufacturers never really thought of. Auto manufacturers just produce a crap load of cars and then try to sell them. And if they don't sell them, they want to sell them at a discount. And then eventually they need to be bailed out because they're giving away too much money, right? What is it? GM is a perfect example back in Oshawa in Ontario, right, where they were bailed out and then they left the province there anyway, so it didn't really matter. So currently Tesla's in the shakeout phase, and they're still growing, but right now it's really the testament to them and their entire being to see what they can do with with the product itself and how they're going to fare against all the competitors that are coming out with their other electric vehicles, whether they be reasonably priced or better made or longer ranges. We're going to see this kind of come to fruition in the next 5 years. I would say that personally, I think Tesla is really going to be able to stick it out. They are the pioneer. They are the ones that created this technology, and they are improving on it ever so often, right? The one thing that I want to say is pay attention to that self-driving technology, because the one very, very, very smart thing that Tesla was doing, every car that people buy, Tesla itself is able to insure the cars because all the data is, you know, able to be transferred to Tesla at any given moment. And also Tesla's map out the roads, right? So they're doing a much better job mapping them out compared to like the Google car that comes by neighborhoods. So I just want to say that personally, I think they still have a lot of potential. But right now, market's going down, and Elon Musk recently purchased Twitter, so it's kind of difficult, you know. I mean, when the guy that is the richest was the richest man in the world, I think that dropped down when he sold his shares, and the stock value decreased, right? But just be aware of what happens with that company in the next 5 years. I foresee them really breaking out and going into their maturity phase, but that's probably even 10 years away. They still have a lot of growing to do in order to be able to scale for what people are interested in. And then the decline phase are like, what's a good example of a company that's kind of declining? Like they're around, but nobody really cares about them so much anymore. Uh, or they declined into oblivion, right? So Blockbuster would be an example. Sears, Kmart, they're the companies that kind of did their thing and now they no longer exist, right? So breaking it down again after that chart, startup or the introduction is companies at the startup stage are likely to generate zero or very low revenue, experiencing negative cash flow and profits due to their large amount of capital initially invested in technology, equipment, salaries, and other fixed costs. Growth, more or less, that's the profitability stage. The company reports quarter over quarter growth at first, followed by year over year. Improvement in their products and/or features increase the value to the customers. Shakeout, consolidation of an industry. Some businesses are naturally eliminated because they are unable to grow alongside their competitors in the industry or are still not generating a profit. These would be stocks with a lot of hype in the growth stage, but the hype has waned and the company is not producing positive cash flow. Maturity. This signals companies that are well established within their industry with little potential growth still to reach. These companies are leaders in their respective sector. And decline. This stage is the final stop for the industry life cycle. Many large established companies do not want to hit this stage, but for some it's inevitable when the economic landscape changes. Think Sears, Kmart, Blockbuster, right? Like I just said. These companies were not able to adapt to a new landscape and have fallen off into memory. Many companies will focus on their most profitable products to stay in the industry. Next up, we have company analysis. And within company analysis, we're going to take a look at management, financial statements, and the intrinsic value. So, how do you discern a strong versus weak management? One good indicator is how long the CEO and top management has been serving the company. The longer the tenure, the stronger the company. Imagine the companies that flip-flop CEOs every 2 years, right? That just shows that either the board really doesn't like the new CEO's idea and want to get rid of them because they're comfortable, or the CEO really does a terrible job every time, right? That doesn't really bode well for all employees. If they see that their management keeps getting shifted over and they have a high turnover rate, the employees themselves are very likely to have a high turnover rate. So companies need to be very careful with that. Completion of stated goals for the company. Analyzing the last 10 years of annual reports is a great place to start. So, mission statements, for example. If a company sets out missions and goals for them that they want to achieve in a certain period of time, and they are able to do so, that's great. If they don't, and they continuously fall short of their goals, probably not so great, right? People who are working for the company or insiders are buying the company's stock. If yes, this is a good indication that management is performing well. And turnover rate. How often do you see help wanted ads for the same position? How long are they left up? And what are the reasons people are leaving? Finding something like that out may be difficult, but but sites such as Indeed or Glassdoor keep a record of employee comments on particular companies, giving you strong information. So, for example, if you go to a company that has a lot of employees, like 10,000 plus, there's going to be a lot of employees that put their piece on the company website. And it's troubling to see, companies that have a 2 out of 5 ranking or a 1 out of 5 based on customer experiences, employee experiences. It's, if they're publicly traded, I would watch out because that is a very strong sign of weak management. There's a few I can name, but I'm going to avoid doing that in the video. Anyway, financial statements and methods. All right, the purpose is to understand the overall health of an organization and to evaluate financial performance and business value. So let's dive into this. This is going to be quite lengthy. So, liquidity ratios. This is the total amount of a company's quick assets divided by the sum of its net liabilities and reinsurance liabilities. This calculation is one of the most rigorous ways to determine a debtor's capacity to pay off current debt obligations without needing to raise external capital. So there's two types of ratios within the liquidity ratio to look at, right? So the first one is a quick ratio, which measures a company's ability to meet its short-term obligations with its most liquid assets, right? So the way to get the quick ratio is to get the current assets minus inventory divided by the current liabilities. And then you're going to get your quick ratio. If it's 1 or greater, that's good. Current ratio. It measures a company's ability to pay short-term obligations or those due within 1 year. So the equation for that would be current assets divided by current liabilities, and that would give you your current ratio. So your current assets are like cash, cash equivalents, short-term investments, accounts receivable, inventory, supplies, and prepaid expenses. Your liabilities are accounts payable, your short-term debt, your dividends payable, and your notes payable. All right, so a ratio of 1 or greater is good. Leverage ratios. There are two types, gross and net leverage ratios. The gross leverage ratio is the sum of an insurance company's net premiums written ratio, net liability ratio, and ceded reinsurance ratio. The net leverage ratio is generally lower than the gross leverage ratio and is usually more accurate. So the debt ratio measures the extent of a company's leverage. If the debt ratio is defined as the ratio of total debt to assets, so 1 or lower is what you'd be looking at. 1 to 1 or 0.5 to 1 would be great, right? So as long as the company has less debts than they have income coming in, that is a good investment. Debt to equity it's used to evaluate a company's financial leverage. So the equation for that would be a total debt divided by the total shareholders' equity. Okay, and interest coverage ratio is used to determine how easily a company can pay interest on its outstanding debt, and for that you want it to be 1.5 or greater. And the rate and the equation for that would be the EBITDA over the interest expense. There's more on the next slide, and it's just a website link, so we'll get to that in a second. Efficiency ratios. These are used by analysts to measure a company's short-term and current performance. The simple formula is right here. It's expenses over revenue. It does not include the interest of the expenses. All right. So for that, there's a few other points to be in mind of. So there's asset turnover ratio, right? Measures the efficiency of a company's assets in generating revenue or sales. The higher, the better. 1 or greater industry dependent. Retail or service sector companies typically have higher asset turnover ratios, while utility and manufacturing tend to have lower asset turnover ratios. Inventory turnover. That measures how often inventory is used and replaced for operations, which shows how efficiently a company uses its inventory. The higher the ratio, the better. Industry dependent, however, right? So, as I was saying, manufacturing versus hospitality, you're going to have different formulas and different ratios that show you what is profitable and what is not. Think Apple compared to Hilton, right? Not saying one is better than the other, just a simple comparison. Day sales in inventory ratio. This indicates the average time in days that a company takes to turn its inventory, including goods that are a work in progress, into sales. The lower, the better. Profitability ratios are a class of financial metrics that are used to assess a business's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time. The three points within the profitability ratios are gross margin, operating margin, and return on assets, or ROA. Sorry, there's four, and return on equity. Four. All right. So the gross margin measures how much profit a business makes after the cost of goods and services compared to net sales or other amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. Operating margin measures how much profit a company generates from net sales after accounting for the cost of goods sold and operating expenses. This ratio shows how much profit is earned for each dollar of sales. Return on assets, or ROA, measures how much of a company's profits are generated from total assets or resources, including current and non-current assets. And return on equity, or ROE, measures how much profit a business generates from shareholders' equity. And finally, market value ratios, also known as book-to-market ratio. This is an indicator of a company's value, comparing what it's worth on paper to what is being traded at. Now, that was a lot of information, guys, and it might fry your brain a little bit. I know it did mine the first time I heard it. I had to go over it for several weeks in order to be able to digest it all, right? But once you get a handle on it and how to find all these ratios, you do your due diligence, you are going to be able to pick long-term winners. This is what Warren Buffett does all day long, guys. Okay? And understanding gross leverage ratio and net versus gross. I just put a link to Investopedia.com here. It's really going to help expand on the terms that I mentioned. And again, I'll put the link in the description just so you know exactly what to look at, kind of go more in depth. But just remember, when you go to your long-term investing or your long-term swing trades, it's very important to understand all of these things in order to actually be profitable in the long term. So this brings us to intrinsic value. This value is a measurement of what an asset is worth, not what the stock is priced at. So let's use Tesla as an example. It's actually worth $45 a share. It is currently priced at $113 a share. It used to be higher, but today it dropped. So I'm going to go with that. Anyway, financial analysis uses cash flow to determine the intrinsic or underlying value of a company or stock. So here we go. The discounted cash flow. This is going to be one very key important phrase for you to remember. Okay, the DCF. Remember DCF. And I'll jump into how this is used right after the slide presentation. Okay. So this refers to a valuation method that estimates the value of an investment using its expected future cash. Net present value, or NPV, is the difference between the present value of a cash inflow and the present value of cash outflow over a period of time. And capital asset pricing model, or CAPM, describes the relationship between systematic risk or the general perils of investing and expected return for assets, particularly stocks. So the discounted cash flow, the present value of the expected future cash flow using the discounted rate. So within that, there's a few other terms to be cognizant of. So the present value. This is the current value of a future sum of money or stream of income given a specified rate of return. Discount rate, or DC. The discount rate refers to the interest rate used in discounted cash flow (DCF) and analysis to determine the present value of future cash flows. WACC is typically used. And what does that mean? That's the weighted average cost of capital. It represents a firm's average after-tax cost of capital from all sources, including common stock, preferred stock, bonds, and other forms of debt. So, the discounted cash flow formula, as you can see, it's right on the right-hand side of the words, and it's in a little box. DCF equals CF1 over 1 plus R to the power of 1. I forget how to use those math terms, but anyway, I know what to do with them. That's the important thing. But anyway, so that is how you get your discounted cash flow formula. All right, so on the bottom, you're going to see the chart from cash flow and discounted cash flow. And typically, you want to add up all of the discounted cash flows that result in whatever value that they have. So in this case, it's 13,306,727. By subtracting the initial investment of 11 million from the value, we get net present value, or NPV, of 2.3 approximate million. All right. Net present value. So this is used to calculate the current value of a future stream of payments from a company, project, or investment. To calculate the NPV, you need to estimate the timing and amount of future cash flows and pick a discount rate equal to the minimum acceptable rate of return. The discount rate may reflect your cost of capital or the returns available on alternative investments of comparable risk. If the NPV of a project or investment is positive, it means the rate of return will be above the discount rate. And on the right is the chart of how to get that equation. Capital Asset Pricing Model, or CAPM, is a financial model that calculates the expected rate of return for an asset or investment. CAPM does this by using the expected return on both the market and a risk-free asset, and the asset's correlation or sensitivity to the market, or beta. Beta is a measure of how much risk the investment will add to the portfolio that looks like the market. So guys, I just want to take you to the few websites that I was mentioning during the video. And GuruFocus.com is extremely helpful when it comes to finding that discounted cash flow. Okay, so yes, you can join up, you can spend money on the premiums, but we simply just want the discount cash flow information. Okay, so let me show you how to find that. For argument's sake, let's pick Apple, APPL. Okay, and don't press enter. You're going to see all the stuff that has those 4 letters in it. Okay, so we know that the Apple stock, Apple Inc., right here is the equity on NASDAQ, and we want what's called the DCF valuation. So click on that, and then you go to a screen that gives you all of this information. So all I am really looking for is what the stock price is, what the fair value is at, meaning what it should be worth, and margin of safety. So margin of safety, if it's in the green, that's a very good decision, because what that means is it's currently undervalued. And with undervalue will come great value in the long term. All right, so that's a great tool here. So now let's take a look at another popular one, Tesla. All right, DCF valuation. Now look at this, fair value is $40 a share. So this shows that it's extremely overbought. Okay, it should be worth $40 a share and it's currently $113. So if you've been paying attention to any watch lists or chat rooms and people are slamming Tesla and should go down to 40 bucks, this is the reason why. Now, here's my prediction with Tesla itself. It's still a growth stock. right? As you listen to in the presentation itself, it's going to be in the shakeout phase pretty soon when in the next 5 years, a lot of the companies are going to be releasing their electric vehicles. So that's going to be a real testament to see how it actually survives. But if you know anything about the companies that you invest in, and if Tesla's one of them, you'll know that they do far more than just sell cars. And that'll come out in the future. Here's another example, GameStop. Let's go that for fun. Okay, so you can see fair value, it should be minus $20. Now, realistically, a company isn't going to go negative 20. The lowest it can go is zero. Okay, so if you ever see something like that that's in the negative, there's two things. Especially keep in mind that if the company is established and you see that, not a good sign. If the company is a growth company, it's in the negative, it's kind of understandable, right? So, for example, Rumble. I'm partial to Rumble. I like Rumble. Okay, so let's take a look. Rumble is negative 99 cents. Okay, but Rumble is a growth stock. It only has been out for less than a year. Okay, so just keep that in mind. It went public less than a year ago, and right now its stock price is 676. So for me, that's still a pretty good bargain. And that's just a personal touch there, right? And another one, let's say something that is established. Let's go Meta. Okay, let's see what their valuation is. See, fair value, $360. So that means they have a huge margin of safety. That means the stock is very, very undervalued at this point in time. Okay, just throwing that out there. If any of you guys paid attention to my videos, well, actually, no, I did not give this tidbit out in any of my videos. I left it for my private group. Sorry about that, guys. Some things are just left for the group itself. And I did mention pick up Meta when it was hanging around the $100 mark, right? So for those of us that picked it up, we're up 30% in the last month and a half. So it's a pretty sweet deal. Okay, and then let's go Carnival. I've always talked about Carnival. Let's see their valuation, negative $64. So you see, not super good. The thing is, though, last week when I checked this out, it was negative 77. So it looks like it's slowly closing the gap. But here's what you need to understand, right? Carnival, they shut down 2020. But as you can see, as far as their growth rate, it's been really good, right? Until that happened. So right now they bottomed out, and we'll see where they actually start growing in the near future. Okay. All right, guys. So that's Guru Focus. So the other one that I mentioned was finviz.com. All right. And this one's very straightforward. This is the entire market as a whole. Here's the heat map right there. So if you want to go communication, let's click on that, right? And within the actual heat map, so look, Google, Disney, let's say entertainment, we want to jump in on that box. Okay. It'll show Disney itself because I clicked on Disney, but if I click Netflix, it'll pop Netflix's chart right here. Okay, so very useful if you just want to take a quick browse, and it gives you all the information, all the numbers down here. Their 52-week range, their high, their low, in percentage, what it actually is as far as the numbers. So very interesting to keep in the back of your mind. Okay, all the links I will post in the description. Well, thank you guys for sticking with me. Hope this presentation was helpful. I truly hope that you guys have a prosperous 2023. And if there were any bits and pieces in this presentation that you struggled with, I would recommend going over it a few times. And again, I'll post helpful links in the description just so you know where to find more detailed information on this. Okay, but stick around. In a few months, I will do a 201 for the more advanced trader. All right, so stick around till then. Thank you very much, and I'll see you next time.